So today, at least, we seem to be coming off of the rut that we saw last week. But how do you view the market's recent downbeat trend? Is this a correction that was needed in stocks, or do you think this is more macro as the path forward for rate cuts remains murky, along with some of those escalating geopolitical risks overseas?
Thanks for having me. Well, look, I think we hadn't seen a 5% correction or 10% pullback in the market in some time. Usually 5% S&P 500 pullbacks happen about 4 times a year. 10% corrections happen about once a year. So it had been a while since the market had seen any significant pullback. I also think we're in earnings season now. Investors are going to be focused on the outlook for guidance, which has been weak. Usually it is seasonally weak at the start of the year, but we'll see if that improves as more companies report. Obviously, we have geopolitics and inflation data that's continued to come in hotter than expected, which we do think many large cap corporates can still hold up if the Fed doesn't cut as soon as some investors may be expecting, but it could prove more challenging for some segments of the market, like U.S. small caps, at least for the near term.
And Joe, you mentioned those hotter than expected inflation prints. We have PCE on Friday, of course, the Fed's preferred inflation gauge. What are you expecting there, Joe? How important is that data point for the market?
Well, I think investors are going to continue to watch the inflation data that feed into what the Fed is looking at. And, obviously January, February, and March, we generally saw inflation data that surprised to the upside. So our economists at BofA had pushed out their expectation for the first Fed cut to December of this year instead of June. So, against that backdrop, we think the Russell 2000 small cap index may be more challenged to outperform until we can get more confidence that inflation is easing. The small cap index does have a lot of refinancing risk. You have, more than 40% of the debt for that index is either short-term or floating rate. But I still think that given the macro picture, there are a lot of positives for, stocks that are more GDP sensitive, more sensitive to the manufacturing recovery or higher commodity prices, that don't have as much leverage or, are as exposed to refinancing risk. So I still think there are pockets of small and mid caps that could be poised to do well near term, but overall that's one reason that the index may be challenged until we get a little bit more confidence that inflation is starting to more sustainably ease.
And Joe, what are those pockets with small and mid cap companies? How would you advise investors to best position themselves there?
Yeah, I think when you look at it by sector, some of the sectors that are more exposed to the GDP, manufacturing recovery, to higher commodity prices, but that have less refinancing risk would be energy, industrials, materials, so the commodity complex. And I think it's an environment where it makes sense to be active rather than passive, pick stocks and sectors, given some of these risks to many small and mid-cap corporates. We do still like value over growth. But, again, I think large cap value may be a bit more insulated near term if rates stay higher for longer. But, the ISM is now back above 50. Manufacturing conditions have improved. So, that is bullish for a number of small and mid caps that, don't have a lot of leverage on their balance sheets.
As the earnings come in fast and furious this week, Jill, I'm just curious, and you're talking to clients, what do you see as sort of the risks for the remainder of this earnings season? Is it the sticky inflation? Is it the strong dollar, geopolitics? Is it all three, Jill?
Well, I think, as we look at the consensus projections for profits growth for this year, a lot of the profits recovery is very back-end loaded. Small cap earnings, for example, are still negative year over year this quarter, and then we see a continued improvement throughout the year, especially in the back half. So, I think just corporate guidance overall will be very important if companies can continue to surprise to the upside, if we see demand coming back, given in prior quarters, we had seen a lot of, margin-driven earnings growth, but to actually see sales recover, I think that will give investors confidence in the back-end loaded earnings recovery that's being forecast for this year.
And what about longer term? We have an election coming up. Do you think that's something that could spur volatility as we close out the year?
I mean, in general, we've seen that volatility does tend to pick up within the market in the months ahead of the election. But I think, for equities, if we get to year end and if we're able to see confidence in the, continued profits recovery, if we are able to see, inflation easing so that it looks like the Fed is able to cut, particularly for small and mid caps, that could potentially set us up for a better year end. Certainly there'll be election issues that'll be impactful to investors, but what we found is that the overall profits and economic backdrop tends to be a much bigger driver of differences in returns than political parties. So we think the macro backdrop will continue to be an important driver of equities in a year where earnings should be more bigger drivers of performance than just multiple expansion, which was more what drove returns last year.
And Joe, we're talking earnings and valuation and Fed. What about seasonality, Joe? How much weight do you put on that? Sell in May and go away?
Well, I think certainly there'll be some seasonality to equity market returns and to profits, contributing to kind of the big 4Q pickup that we see. There'll be months in the year that do tend to have more seasonality, but I think this year in particular, the factors like the inflation backdrop and the Fed and the macro data will be important drivers of the trajectory of equity markets from here. And we do expect further upside to the S&P 500. We have a 5,400 year-end target. And again, I think it's going to be a story of earnings coming through this year, of demand recovery. Certainly geopolitics and will be a factor to watch, but modestly higher oil prices could be positive for areas like energy. If you do see oil prices continue to rise, that can hurt more of the lower end retailers, consumer staples. That's one of the reasons we're more positive on consumer discretionary than consumer staples sector.
And Joe, we talked the Fed a few times. I'm hearing increasingly that there is a possibility that we could see no rate cuts this year. How will that impact something like your S&P 500 target or even some of those small cap names?
Well, I think we've gone from 0 to 5 on rates, and the S&P 500 companies have been able to manage that. We've obviously seen margins impacted, but companies have been able to exercise pricing power in many cases. Now, obviously, if rates were to continue to move higher and inflation were to continue to move higher, this becomes more and more challenging. Some companies have cited it, you can only raise prices so many times. But I think if we're on a path to inflation starting to ease, whether it's a cut in December or potentially next year, that should still be a positive. That said, if we're on a higher for longer rates path with uncertainty over whether cuts are in sight, we think that large cap corporates are much better able to manage that than small caps, where for the S&P 500, about 80% of the debt is long-term fixed rate debt. Companies were able to lock in low rates, whereas for small caps, only about 45% of the debt is either short-term or floating. So this becomes a bigger and bigger earnings impact, especially as you go out to 2026 and beyond, when a lot of debt is coming due.